Hey, Bulls and Bears, JJ here. I'm back, and I'm glad to see you are back. And let's go ahead and get right into the financial news. Things are playing out pretty much like we expected here. We've got this bank term funding program set to expire if they hold true to their word, set to expire this month on March 11th. And what did I say? I said they'll probably come up with a new program or a new funding apparatus, for lack of a better term, to keep these banks liquefied because so many people are, one, don't have enough money to keep in the banks to begin with, and two, a lot of the people that have money to save in the banks or keep in deposit are pulling their money out of the bank because of financial hardship, one, and because distrust in the banking system, two, and a few other things. But take a look at this article. This goes right along with what we said would likely occur. New York Times, bank runs spooked regulators. Now a clampdown is coming. The Fed, officials, and other bank regulators could roll out a new proposal this spring to ward off a repeat of 2023's banking turmoil. So everybody realizes that the banks are insolvent. And some people say, no, they're not insolvent. What are you talking about? Folks, when you need constant rescue programs and liquidity programs and propping up of the banks, that means they're insolvent. Just ask yourself a simple question. Why? Why do we need these programs if the banks are able to function on their own, right? Think about it. And I still get messages saying, no, the bank, what are you talking about? The banks are fine. The banks are fine because they're being propped up. They're being liquefied with these emergency funding programs. The latest one's been going on for a year now. It's going to expire this month. Supposedly. And I said, what would happen? Look, New York Times, they're saying the same thing basically. Hang on, let's take a look here. Here it is right here. 1 year after a series of bank runs threaten the financial system, government officials are preparing to unveil a regulatory response. So guess what? What type of regulatory response are we going to see? Constant injections from the Fed? I mean, from the central bank? I mean, what do you think this is going to be? Please let me know what you think down in the comments. When it comes to new regulatory proposals, do you actually think they're going to pass regulations to make it harder on the banks? Or do you think they're going to pass regulations to make it easier on the banks? The banks already don't have to have any money in reserves. How much easier can they make it? And even with that, the banks still have big problems. Massive losses on their real estate loan, commercial real estate portfolios, and it's going to be residential real estate here in the not too far future when home prices continue to correct. If they allow home prices to correct, we'll have to see what kind of rescue programs they come out with for the housing market. Well, let's get into some other news here. Take a look at this out of Bloomberg here. Economic indicators informing the March Fed meeting. So we've got more inflation, folks, but yet we've got the Fed out there having a meeting later this month to decide if they need to hold steady or pause or cut rates. Folks, this is insane. Why would they be talking about cutting rates when the cost of living has not come down? The rate of inflation came down, meaning things aren't going up as fast as they were, but they're still going up. But yet we're talking about rate cuts, right? It's the most insane thing ever. It doesn't make any sense. It doesn't pass the sniff test. It's basically easily debunked. Let's take a look here. March Fed meeting is expected to leave interest rates unchanged. Well, they actually need to raise rates, right? If they're looking to get to a 2% inflation target, we need lower inflation. It's still in the 3% range if you look at the official number. If you look at the unofficial number, I mean, let me know what your guess is. I'm estimating between 20 and 25% when you factor in everything that people have to pay for, just insurance alone, home, auto, health insurance. I mean, it's all crazy expensive, way over 3%. Expected to leave rates unchanged. Well, they need to raise rates. Of course, they won't do that because they've already stalled the housing market out. The housing market, we're seeing the lowest sales since the financial crisis. Now, people sometimes think that low sales, no big deal, right? Because sellers aren't putting their homes on the market that quickly. Well, we're going to talk about what's happening with that in just a few minutes here. But low sales volumes have a massive impact on the economy. All the people connected in the real estate industry that rely on transactions are going to really feel the pinch here, and you're going to start seeing debt explode. Consumer debt is already high. It's already a record high. It's going to start exploding even faster as we go into the coming months here into the summer. And I expect bankruptcies to really start picking up here. But think about it, the low transactions, the loan officers, everyone working at the banks, the appraisers, the underwriters, the home inspectors, the title people working at the title companies. So many people connected. The people at the furniture stores, home improvement stores. We're already seeing a big slowdown in home improvement, construction material sales. Just watched a video from Uneducated Economist. Huge slowdown in his retail center up in Oregon. Like he said, he hasn't seen in a very, very long time. Just the volume of homes turning over is affecting a lot of different people, a lot of different industries. So I don't see us getting out of 2024 without something major. The last time I felt like this was 2020. Of course, we had huge cash inflows into the economy in 2020, bringing the markets back up. And keep in mind, they can pump the stock market up while everybody on Main Street goes broke. So Wall Street can remain resilient while Main Street is basically broke. All right, let's get into housing since I did touch on that here just a couple minutes ago. The National Association of Realtors sees rents falling and interest rates to follow. And what do we talk about rents? We talked about rents have to do with how well the consumer is doing. It's not how much people can borrow. Most people, anyways, aren't borrowing money to pay their rent. They're borrowing money to buy a home, but not to pay the rent. So when rents fall, that means people just don't have the money, because otherwise landlords would just raise rents. If everybody could pay it, landlords could just raise rents forever. But it gets to a point where the home or the apartment sits empty because people just don't have the money that the landlord is demanding. So then what's going to happen? Naturally, rents need to drop. So rents dropping, that's huge. Even if it's just a little bit, that tells you that people are tapped out. People don't have enough money to pay for these costs. In a speech about trends in the residential real estate market, Lawrence Young, the chief economist for the NAR, said he believes the consumer price index, a common inflation metric, will begin to reduce more this year, which still reducing is not enough. We need deflation. In turn, allowing the Fed to cut interest rates. So more talks about we need a rate cut. That's what these people connected in the real estate industry. They're praying and hoping for rate cuts. The volumes have dropped off of a cliff. If you look at a chart, it looks like the financial crisis of home sales. In fact, let me just bring one up here. Folks, take a look at the chart right here. 2008, housing bubble went bust. 2020, brief drop in homes sold. Look to the all the way to the right edge here, and we're just about where we were coming out of the housing bubble, right? 2010. This is a 14-year low, folks, and it's slowing down even more as we speak. All right, so I don't think we get out of 2024 without some big, huge economic things happening. There could be even something bigger to bring down this entire system, this entire economy, where we see a big sell-off. That's why I would urge people, have cash, have emergency essentials, food, water, goods, survivable goods, in case something big drops, because we see a lot of hostile nations out there against the U.S., countries ditching the dollar. Remember, it used to be an act of war to trade outside of the dollar, right? There was an agreement made a long time ago, Bretton Woods, that oil would be traded only in dollars, and in response or in trade, the U.S., we would actually use our military to support these other countries. Now, we're still doing that. We're still funding other countries and funding conflicts across the globe, but that used to be, we had to have these other countries trade in U.S. dollars. Countries are ditching the dollar, trading outside of the dollar. There's so many countries now trading outside the dollar, we can't possibly go to war against all these other countries, right? So we could see, I think, a major act of a war against the U.S. I'm thinking some sort of swan event, some outage, the grid goes down, something big. So be on the lookout for that. But otherwise, the consumer is going to be tapped out some point this year is what I'm seeing. Please let me know your timeline, but I don't see the consumer getting through the end of the summer into fall unless some major rescue programs are rolled out. We already have some happening right now with the FHA loans, with the student loans, just to name a few. I think it's going to be massive rescue programs again. How else is the consumer going to get through this with the debt, right? So we're going to be on top of it, folks. A lot of you are up big on some of the trades that we talked about here recently. I'm up about 50% on a trade. So I think you and I and the people here on this channel, we're going to skate through this just fine. But you've got to benefit from the carnage, right? So be ready. Otherwise, continue stacking, investing wisely, but be ready for the big fall. That way, you're going to have some cash. And if you're able to save cash, you're in a very small percentage of the population. Most people aren't able to save. In fact, most people are going deeper and deeper into debt each month. So hopefully that's not you or most of us here anyways. Everybody, let me know what you think about this, the sales volumes, the calls for interest rate cuts again, the calls for lower rents out of the NAR. And what was the first article we talked about today? The New York Times. New York Times saying that we're going to have new implementation of new rescue programs, right? So insane, folks. Exactly how we said it was going to play out. It's happening. So keep stacking, folks. We'll see everybody very soon. Thanks for being here. Talk to you down below in comments here. We'll hopefully see you down there. Big love, everybody. Peace. Bye.